Cross-sectional factor mining is the systematic search for variables that explain future return differences across assets at the same point in time. Unlike time series strategies that bet on market direction, this approach profits from relative strength, identifying which assets will outperform their peers. The universe is the asset pool you trade, and it is the most underestimated and fatal step in the entire process. A cross-sectional strategy needs assets that are similar enough to compare but different enough to spread. In US stocks, you start with liquidity pools like the S&P 500 or the top 1500 by dollar volume. You filter out penny stocks and require a listing history. Crucially, you must include delisted stocks to avoid survivorship bias, which would otherwise inflate backtest returns. In crypto, the universe is a rolling top 50 by market cap, updated frequently to avoid look-ahead. You require daily volume above $10 million to avoid manipulation traps. You exclude coins listed less than 90 days, stable coins, and wrapped tokens. The key difference: crypto returns concentrate in the top 40 coins, while small caps are dominated by liquidity constraints and idiosyncratic risk, making them unreliable for cross-sectional comparison. Candidate factors come from four sources. The first is theory. In US stocks, you have the Fama-French factors: value, quality, growth, momentum, size, and liquidity. These have economic logic. In crypto, traditional stock factors have zero explanatory power. You must mine crypto-specific factors: market excess return, size based on network adoption, short-term momentum of 1 to 4 weeks, and reversal. On-chain factors like active address growth and hash rate growth can fit returns with an R-squared of 88%. The second source is price-volume derivatives, returns of different powers, VWAP deviations, high-low ranges, overnight gaps. The third is machine learning aggregation, like the trend paper that combines 28 technical signals. The golden rule: start with economic logic, then test. Pure data mining produces 99% overfitted factors, which fail out of sample. Data quality decides strategy success. First, handle missing values. For less than 5%, delete. For fundamentals, fill with industry or market cap means. Use medians when outliers exist. For crypto on-chain data, Winsorize at 1 and 99% to prevent extremes from poisoning the cross-section. Second, treat outliers. The 3 sigma rule truncates beyond 3 standard deviations. The MAD method is more robust. Winsorize to 1 or 99%. Crypto needs aggressive treatment because 50% daily moves happen. Third, standardize cross-sectionally. The Z-Score formula converts factor values to comparable units. The trend paper uses rank transformation to the interval -0.5 to +0.5, which is most robust to outliers and preferred in crypto. Finally, unify factor direction, so that low values for volatility become positive factors, ensuring that higher scores always indicate better expected performance. The Z-Score standardizes each factor value relative to the cross-section. For each asset I at time t, subtract the cross-sectional mean and divide by the standard deviation. This removes scale differences, making factors comparable. In crypto, a rank transformation is often preferred because it is more robust to extreme values. To validate, observe the distribution of the transformed factor. It should be roughly symmetric. Estimate the mean and standard deviation on a rolling window. If the factor's Z-score is highly skewed, the rank transform is better. Falsify the assumption if the Z-score distribution changes dramatically over time, indicating instability. For example, if a factor's Z-score distribution shifts from normal to bimodal, the factor's relationship with returns may be unstable, and the rank transform might be more appropriate. Neutralization determines whether your factor is true alpha or disguised risk. In US stocks, you neutralize by industry, market cap, and style. The Fama-MacBeth two-stage regression removes these exposures. In crypto, there is no clear industry, but you must neutralize BTC exposure because BTC is the implicit benchmark for all coins. Also neutralize market cap and liquidity. Orthogonalization verifies that your reversal factor is not captured by size. A counterintuitive fact: the traditional momentum factor in stocks becomes a reversal factor in crypto. So crypto momentum must be redefined with 1 to 4 week windows, not 6 to 12 months. This is a critical difference. For example, a stock that rose over the past year tends to continue rising, but a crypto that rose over the past month tends to reverse, so you need to adapt your factor definitions. The Fama-MacBeth two-stage regression removes known exposures. In the first stage, regress returns on industry, log market cap, and style factors. The residual is the neutralized factor value. In the second stage, you use that residual in your cross-sectional test. This ensures your factor is not just a proxy for size or industry. To validate, check that the residual has no correlation with the removed factors. Estimate the regression on a rolling window. If the residual still correlates with size or industry, the neutralization is incomplete. Falsify the factor if its predictive power disappears after neutralization. For example, if a value factor's IC drops to 0 after neutralizing for size, it suggests the factor was just a size effect in disguise. Each candidate factor is tested individually. The information coefficient, or IC, is the correlation between the factor and next period returns. An IC mean above 0.03 is considered effective in US stocks. The ICR, or IC information ratio, divides the mean by the standard deviation. Above 0.5 is excellent, 0.3 to 5 is good, below 0.3 is weak. You also do decile tests, sort into 10 groups and see if the top outperforms the bottom monotonically. Check turnover and transaction costs. In US stocks, costs are 5 to 10 basis points per side. In crypto, round-trip costs exceed 20 basis points. Test sensitivity to fees. Also check sub-period independence. The factor should work in bull, bear, and sideways markets. Crypto has special tests, weekend effects, September weakness, and the risk of short squeezes on the short leg. The information coefficient measures the rank correlation between the factor value and the next period's return. A positive IC means the factor predicts relative performance. The ICIR is the mean IC divided by its standard deviation, indicating stability. To validate, compute the IC over rolling windows. Estimate the mean and standard deviation. If the IC is positive but highly volatile, the ICR will be low. Falsify the factor if the IC is not consistently positive across subperiods. For example, if a factor has a positive IC in bull markets but negative in bear markets, it may be a risk factor rather than alpha, and you might need to condition on market regime. Combine the selected factors into a composite score. First, check correlations. If two factors have a correlation above 0.7, keep only one to avoid redundancy. In US stocks, a typical set is value, momentum, quality, and size, which are lowly correlated. In crypto, use short-term momentum, reversal, illiquidity, and on-chain activity. The synthesis method depends on your goal. Equal weighting works when ICRs are similar. IC weighting assigns more weight to factors with higher ICR. Risk parity equalizes volatility contributions. Machine learning, like XGBoost, can capture nonlinearities. Dynamic weights are crucial because factor decay is real. In US stocks, value decayed from 2007 to 2020, and momentum decayed after 1995. In crypto, factors can decay within months. Use rolling window IC weighting, re-estimated quarterly. Finally, build the portfolio. Top-end selection buys the highest scoring assets. In US stocks, N equals 50. In crypto, N is 3 to 5. Weighting schemes, equal weight, market cap, inverse volatility, or performance weighting. Rebalancing frequency, monthly for US stocks, weekly or 30 days for crypto. A crypto-specific addition is the BTC regime filter. If the 90-day moving average of BTC is above the price, go full risk, otherwise cut exposure in half. Empirical evidence suggests this filter can improve the Sharpe ratio of a crypto cross-sectional momentum strategy to 2.54 after costs. But remember, such numbers are illustrative, not guaranteed. The filter works because it reduces exposure during downtrends, avoiding large drawdowns. The biggest pitfall in cross-sectional mining is overfitting. Here are 5 non-negotiable disciplines. First, avoid look-ahead bias. All signals must use data available at the time, so shift returns. Second, walk-forward validation. Tune on the first 60 to 70% of data, freeze parameters, test on the remaining. Third, use the deflated Sharpe ratio to correct for multiple testing. Fourth, check the parameter plateau. The optimal parameters should be on a flat region, not a sharp peak. Fifth, ensure subperiod independence. The strategy should make money in bull, bear, and sideways markets. These disciplines separate robust factors from noise. For example, if a factor's performance is driven by a single extreme month, it's likely overfitted. Let's summarize the key differences. The primary factors differ. US uses value, momentum, quality, size. Crypto uses market, size, short-term momentum, reversal, illiquidity, on-chain. Momentum windows, 6 to 12 months in US, 1 to 4 weeks in crypto. Fundamentals, rich in US, almost none in crypto. Neutralization, industry and size in US, BTC exposure and liquidity in crypto. Shorting, easy in US, risky in crypto due to short squeezes. Factor decay, slow in US, fast in crypto. Costs, 5 to 10 basis points per side in US, over 20 in crypto. 24-hour trading, no weekend effect in US, significant in crypto. Universe construction, stable in US, must be rolling in crypto. These differences mean you cannot simply transplant a US stock strategy to crypto without significant adjustments. Cross-sectional factor mining is a systematic search for relative value. The pipeline we outlined works in both US equities and crypto, but the engineering choices must adapt to the data climate. In US stocks, you have decades of fundamentals and stable factors. In crypto, you have fast-moving on-chain data and extreme volatility. The key takeaways: define your universe carefully, neutralize known risks, test factors rigorously, and defend against overfitting. Remember that factor decay is real, and dynamic weighting is essential. The future of quant research lies in adapting these principles to new asset classes. We read them all. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.